All right, today we are doing something a little different. We're going to crack open an analyst's case file and go behind the scenes of a high stakes trade. We are going to deconstruct piece by piece how they built a case for a major move in Meta. So, this is the $1 million question, right? After an absolutely massive run, Meta's stock just took a serious nosedive. So, is this the beginning of a bigger collapse, or is this one of those golden buying opportunities? Well, one analyst is betting on the latter. Let's find out why. In this breakdown, we're not just going to give you the conclusion. Nope. We are going to take you on the investigation. We'll follow the exact same clues, weigh the evidence just like they did, and see how a trading thesis is built from the ground up. Ready to play detective? Okay, so every good investigation starts with a mystery. And ours, it's this sudden, kind of stomach-churning drop in Meta's stock price that has everybody asking, what on earth happens next? Okay, let's dive into this. The stock was just on an absolute tear, hitting highs around $715, and then, bam, a hard drop, all the way down into the $610 range. Now that's a move that would make any investor nervous. The analyst's job here is to figure out, is the company itself in real trouble, or is this just the market doing its crazy volatile thing? To solve this puzzle, our analyst is pulling out a special tool from their toolkit. You could almost call it their secret weapon, one designed to try and read the market's collective mind. So what is this thing? It's called Elliott wave theory. Basically, it's a way of looking at charts and spotting predictable patterns. The core idea is that the market moves in these repeating waves, and those waves are driven by the collective mood swings of all of us investors, swinging from optimism to pessimism and then right back again. Our analyst is using this to map out where Meta might be in that emotional cycle. So, looking at the daily chart, the analyst spots 4 huge clues. First, the shape of the price drop. It looks like what they call a completed wave, like the final act of a selling spree. Second, a little indicator called the RSI is practically screaming oversold. Third, another tool, the MACD, is showing that the sellers are, they're running out of steam. And finally, and this is a big one, that huge spike in trading volume, that often suggests capitulation, which is just a fancy word for the moment sellers finally throw in the towel and give up. So all these initial clues point to one hypothesis. The selling is probably over, or at least very close to it. But, in trading, one clue is never enough. You have to build a case. So now, we need to hunt for more evidence to see if it backs this theory up. And this is where it gets really interesting. Our analyst is now on the hunt for other clues, using totally different tools to see if they're all telling the same story. And boom, here's our next major piece of evidence. The price has fallen to a very specific, almost magical level for traders, the 61.8% Fibonacci retracement. Just think of it like a mathematical support zone, where prices very often stop falling and start to turn around. The fact that Meta's price landed right in this zone is a huge piece of the puzzle. Now, what's really interesting about this slide is a concept called divergence. Check this out. The stock's price is making a new low, right? Which on the surface looks pretty bad. But at the exact same time, our momentum indicator, the RSI, is actually making a higher low. It's like the price is screaming, I'm getting weaker, but the underlying momentum is whispering, actually, I'm getting stronger. That little disagreement is a classic signal that a reversal could be just around the corner. But our analyst isn't stopping there. They're pulling out yet another tool, this time something called the Wyckoff method, which is all about reading the story that trading volume tells us. And what's the story here? It's showing signs of a selling climax. In plain English, that just means the sellers are exhausted. They're all tuckered out. So the charts are starting to look really compelling. But let's be real. A pretty chart isn't going to save a company that's falling apart. So it's time for a fundamental reality check. So is Meta actually in trouble? The analyst does a deep dive and finds, nothing. No horrible company-specific news. The drop seems to be mostly in line with the entire tech sector taking a bit of a breather. Meanwhile, Meta's big long-term projects like AI and monetizing Reels are still looking really solid. The final verdict here? The company seems fine. This looks like a market issue, not a Meta issue. Okay, the evidence is in. We've examined the clues from the charts. We've done our reality check on the company itself, and everything seems to be lining up. Now it's time for the big reveal, the final verdict, and the actual game plan.
So, the crucial point is, all the evidence is pointing in the same direction. The wave structure says the selling wave is complete. Momentum is oversold and showing that bullish divergence. The volume shows sellers have likely given up, and the company's fundamentals are still intact. For our analyst, the case for reversal is confirmed.
So how would someone actually trade this idea? Well, here's the analyst's paper trading plan. And of course, remember, this is just an example, it's not financial advice. The entry zone is between 605 and 612. The potential targets are 640, 677, and maybe even a retest of the old highs up at 714. But honestly, that's not the most important part. This right here, this is the most important part of any trade plan. The analyst has a crystal clear uh-oh point. If the stock breaks below $592, the whole theory is wrong, and it's time to get out, no questions asked. See, it's not about being right 100% of the time. It's about having a plan for when you're wrong. And that's how you deconstruct a trade. We've seen how an analyst layers different tools and pieces of evidence to build a compelling case. The real lesson here isn't just about metastock, it's about the process. This is just one analyst's map for navigating the markets. So now I'll turn it over to you. How would you have read the clues?
Welcome to the deep dive. Today we are really getting into the weeds with something complex. We're looking at one of the most specialized financial analyses we've ever come across.
Yeah, this one is dense.
It's this incredibly detailed, multi-layered report on Meta platform stock, and it's all focused on one thing: identifying a potential, very sharp, short-term reversal.
Right, and this isn't just someone looking at a price chart and making a guess. We're talking about watching highly sophisticated technical systems. Well, merge. This analysis uses Elliott wave theory, for one.
Okay.
Then it layers on Wyckoff accumulation principles, and then it cross-references all of that with hard momentum indicators like the RSI and the XED.
So our mission today is pretty critical then. It's to translate that, all that specialized language, the jargon, the wave counts, into clear, understandable insights for you. We need to walk through why this potential reversal is being spotted right now. And the whole conversation, it really centers around Meta's recent price action, specifically that really severe drop that took the stock from highs near, $715?
Right, all the way down to that $610 region.
Exactly.
What's fascinating here is that we're looking at a situation where multiple, independent technical systems all converge to signal something really powerful, seller exhaustion. The analysts, they checked everything. Moving averages, fractals, volume profile, the works.
So the argument is that this sudden, painful correction has just run out of gas.
It's run out of destructive steam, yeah. At least for the short term.
Okay, so let's unpack that aggressive move down. The source material describes that slide, the drop from $715 towards $610 as looking exactly like a completed wave 3 impulse.
Right, and that's within a larger ABC corrective pattern.
So that name alone, that tells us it was fast, decisive, and probably pretty painful for anyone who is holding the stock.
Oh, absolutely. And you can actually quantify the pain when you look at the momentum oscillators. The daily chart RSI, for instance, it bottomed out at approximately 28.
Wow. Okay, that's well into deeply oversold territory.
Deeply. And on the 30-minute charts, where you can see the real short-term velocity, it even briefly touched 20.
So those extreme readings, that's kind of the signal.
That's classic.
Yeah.
It's where a strong corrective wave, like a final wave C or a wave 5, tends to find its termination point. The market just, runs out of energy to keep selling.
Running out of energy, that sounds like exhaustion, or what traders call capitulation, right? How does the volume activity confirm that story?
Well, we saw a huge spike in volume, exactly at the sharpest point of the decline. That high volume bar, it signals capitulation behavior.
Panic selling.
It's panic selling from the last of the weak hands. Think of it like watching the last few runners just collapse at the marathon finish line. They've spent everything, and the only move left is for things to stop going down. That high volume is proof that the supply of sellers has spiked and is now probably drying up.
And what about the MACD? Is it telling the same story?
It is. The MACD histogram, which, it tracks the velocity of momentum. While it's still negative, you can see it visibly flattening out.
So if it's negative, bears are still in control. But if it's flattening,
it means the speed of the selling is decreasing rapidly. And that's a crucial early warning sign that this destructive phase is coming to an end.
Okay, so Elliott wave says we're near the end. Momentum indicators are saying sellers are tired. All of this pain has to lead somewhere. Where does the analysis say the critical support level is, the real line in the sand?
This brings us to, I think, the single most critical price zone in the entire report, $605.
605.
That is the absolute line in the sand for this whole setup to work. And the reason it's so significant is because it aligns perfectly with the 61.8% Fibonacci retracement of the last major rally, the one before this correction.
And when those two things line up, a wave termination and a key fib level, that's a big deal.
It gives that level immense structural power.
Yeah. And the analysis doesn't stop there. It also layers on the Wyckoff strategy, which is all about identifying market structure.
Exactly. Wyckoff theory basically outlines how smart money accumulates shares after a big decline. So if the price can stabilize around that $605 level, the report expects we'll see the formation of a selling climax, or SC.
Which we probably just saw with that volume spike.
We likely just witnessed that, yes. And that should be followed pretty quickly by an automatic rally, or AR. The AR is what confirms that aggressive buyers have finally stepped in to absorb all that supply. It marks the beginning of the accumulation phase.
Okay, but let's play the skeptic here for a second. This all sounds a little perfect, and the market loves to punish perfection. You mentioned the risk of a spike-down liquidity grab. That sounds like something designed specifically to trap traders who are getting optimistic too early. How can we be sure this is real accumulation and not just a quick stop on the way down to, say, $570?
That is a completely necessary challenge. And the risk is high, precisely because of the market structure below $610.
Yeah.
This is where the volume profile, or the VPVR, comes in. The VPVR shows us where lots of volume is traded at specific prices. And below $610, the volume profile is thin, really thin, until you hit about $585.
So there's a vacuum.
It creates a vacuum, exactly. If that support breaks, the price can fall very, very quickly, which is what allows for that aggressive spike down. It's a brief dip to flush out any early buyers who have their stops set too tight right before the real move up happens.
So that risk window is defined. The analysis puts the next Fibonacci target at $595, which sort of defines the bottom of that zone. If the price falls below $592 on heavy volume, the whole idea is invalid.
Precisely. The thesis is broken. Now, to reinforce the bullish case against that risk, the report points to a really key technical development, the emergence of positive divergence.
Wait, hold on. For anyone new to technicals, that's a crucial term. What is it functionally telling us here?
Functionally, it's telling us that the bears are losing power, even if the price is still sinking. Positive divergence happens when the price makes a new lower low, but the momentum indicator, in this case the RSI, fails to make a new low with it.
I see.
The analysts observe this. It's a loud signal that the selling conviction is weakening dramatically just beneath the surface, and that's what primes the stock for a sharp reversal.
So if we look at the source of all this selling, we have to ask why this drop even happened, especially if Wyckoff suggests a strong accumulation structure is forming. Was there some fundamental crack in the meta story?
And this is where we connect the technical picture to, the fundamental reality. The source indicates this correction is overwhelmingly technical, not fundamental.
So what caused it?
It's actually pretty simple. Mass profit taking after that enormous rally they had post-earnings, and just broader tech sector rotation. A lot of Nasdaq Q money moved temporarily into more defensive sectors.
And what gives the analysis confidence to just dismiss a fundamental collapse?
Well, the company specifics remain incredibly robust. I mean, yes, they face constant scrutiny, but the long-term drivers are still there. We're talking about the aggressive long-term investments in generative AI and the massive progress they're making in Reels monetization.
Right.
We're seeing continued, resilient growth in ad performance that underpins their revenue. This correction was just a technical flush-out. It cleared the decks of over-leveraged traders and short-term profit takers. It was not a reassessment of the company's long-term value.
And because it was a sector-wide thing, that Nasdaq Q rotation, the analysis suggests monitoring other related stocks. They point out that GOOGL, MSFT, and especially NVDA are all showing similar signs of corrective exhaustion.
That's right.
So confirmation from Meta shouldn't just rely on its own chart. We should be looking for a synchronized reversal in the whole tech market, probably by watching the QQQ ETF.
Let's synthesize all these elements now, because this is what makes this setup so powerful.
Yeah.
It's the confluence.
Okay.
We have Elliott wave giving us the timing, the completion of wave C or 5. We have the Fibonacci retracement giving us the exact level, that $605 mark. We have Wyckoff theory giving us the market structure from capitulation to accumulation. And then the momentum indicators confirm the internal health of the move oversold RSI with positive divergence.
So it's not just one signal. It's 4 different disciplines all pointing to the same thing.
Which is far more powerful than any single indicator telling you to buy.
That convergence, then, that's the justification for the risk. This is where the rubber meets the road. The source provides a very specific paper trading setup for you, the learner, so you can simulate this trade with tight parameters. It starts with the entry zone, which is set between $605 and $612.
And as you stress, the risk management is paramount here. The stop loss, the invalidation point, is set tightly at $592.
Right.
If the price breaks $592 on strong volume, the entire reversal setup is nullified. It's over. And we should expect that deeper retrace down towards $570 would just make all of this, well, void.
And on the upside, the targets are tiered. They're aimed at key resistance zones from the volume profile and past chart history. So target 1 is at $640, the immediate resistance. Target 2 is at $677. And the extended target, which it brings us almost all the way back, is $714. This gives you a calculated risk-reward ratio of about 2.5 to 3.0.
Which is an excellent risk profile for a short-term swing trade.
Yeah.
And just one final point on those upside targets. That high-volume supply zone between $714 and $720 is identified as the major overhead resistance. Getting through that level would require more than just technical exhaustion. It would need some renewed, sustained, fundamental enthusiasm to push through.
So what does this all mean for you? We've gone from charting this really complicated drop from $715. We've analyzed that pain through the lenses of Elliott waves, Fibonacci, and Wyckoff. And we found all three systems converging perfectly to pinpoint that $605 stabilization zone.
Yeah.
It's a textbook illustration of how these diverse, really complex strategies can all arrive at the exact same conclusion when the underlying market structure supports it.
And this raises, I think, an important final question for you to consider. How often is the market reacting purely to its own internal mechanics? To wave theory, to exhaustion signals and these accumulation structures, rather than being driven by breaking news or the latest fundamental report?
Right.
This analysis really shows the power of technicals to isolate these sharp short-term moves, even when the long-term fundamental story, built on pillars like AI and reals, remains incredibly strong and intact. Sometimes the market just dances to its own structural music.